Welcome back. We've just published our latest long form essay on Substack.com, The Real Cost of Inflation. We're going to give you a little synopsis about what it's about. But if you're interested, you can read it for absolutely for free on Substack.com, and we'll include a link in the comments of this video as well. Well, we see these reports such as the Consumer Price Index, which measures the change in the prices for the typical basket of goods and services. Latest numbers of 3.3%. And we look at these numbers and we probably ask ourselves, well, they're telling us prices only went up 3.3% over the past year. But when we go to the supermarket, when we go to the gas station, sometimes it feels like a lot more. Well, the consumer price index simply measures the change in the consumer prices, but it may not accurately reflect the consumer experience, the cost of living. Well, what our attempt here is to better describe it with some homemade custom indicators to better describe what is the cost of living and how much that has changed over time. So we took data going all the way back to 1980, so many, many years of data, and we took very basic snapshots of our experience as a consumer. For example, the average cup of coffee. The average cup of coffee was a little bit less than $1 in the 1980s versus the minimum wage at the time. So we ask ourselves, how many cups of coffee could we buy with 1 hour of minimum wage? Well, 1980, that was 3.3. We could buy 3.3 cups of coffee. Well, that sank, and that was 3.3. That was the standard at the time. That sank down to 2.2 in the height of the inflationary period of time we saw 2006, 2007. Things got a lot more expensive. Prices went up. The economy was strong. Well, so the consumer making minimum wage was able to afford a lesser amount of coffee. Now, then we had the financial crash, stocks came down, prices came down, maybe the price of coffee also came down. And as a result, we were able to afford a little bit more 3.0. Well, currently, the consumer making minimum wage can only afford about 2.1 cups of coffee. So that's the lowest low we've seen going back all of this time. We may ask ourselves, how many years of making the average salary do we need to buy a house? Now, this is excluding, of course, taxes and any other expenses. Let's assume we take every single dollar of our salary home. Well, in the 1980s, we would have to work only 5.6 years in order to save up enough money to afford what an average cost of the house at that point. Well, then, of course, we saw the tech bubble and then the subsequent stock market bubble, 2005, 2006, and 7, accompanied with a housing bubble. Well, then that required 8 years of labor in order to buy the average house. Houses were a lot more expensive. Well, then we had the housing crash. Then we only had to work about 6.2 years in order to afford the average house. Well, currently we're sitting at 8.1 years last year, this is 22, and 7.9 years on 2023, respectively. So we can see here very, very interesting situation. We now need to work 8.1 or 7.9, around 8 years in order to afford the average price house based on the average salary in the US. Notice it's around the same level as where we were pre-financial crisis of 2006, 2007. Maybe some cause for concern. We take a look at the Dow Jones Industrial Average versus 1 ounce of gold. Gold is certainly a hedge against a falling dollar in an inflationary cycle, but is gold a good investment compared to the stock market? Well, going back to the early 1980s, we could buy 1.6 ounces of gold for every 1 unit, every share of the Dow Jones Industrial Average. Well, fast forward and 1.6, it was about the same, they were about the same level at that point. Fast forward to 1999, 2000, we could buy, because stocks were so strong and gold actually was so weak, we could buy over 41 ounces of gold for every share of the Dow Jones Industrial Average. Well, the next thing you know, the stock market came down and gold went up. And then we could only buy 7.7 ounces of gold versus one share of the Dow Jones Industrial Average, share meaning wherever the index was at the time. So we can see gold went up and the Dow went down a lot in the 2008 crisis. Fast forward to present day, we can now afford a little over 19 ounces of gold for every one share of the Dow Jones Industrial Average. Certainly an improvement from prior years, but not nearly where we were in 1999 with such strong stocks, relatively speaking, compared to such weak gold prices. We take a look at the average salary in the early 1980s. How much stock could the average salary afford? Well, the average salary at the time could afford 15.7 shares of the Dow Jones Industrial Average. Then we fast forward to the tech bubble in the late 1990s, and the average salary could only afford 2.7 shares of the Dow Jones Industrial Average. The stock market went down in 2008 quite a bit. We could afford a little bit more at 4.7, but currently we're at 1.7. Salaries have not been able to keep pace with the Dow Jones Industrial Average. You take the average salary in the country right now, and we can only afford 1.7 shares of where the Dow is at this point. Well, we may ask ourselves, what has been the best investment? What has appreciated the most over time? Well, from 1980 through 2023, a cup of coffee has gone up 276%. The average salary has gone up around 410%. Minimum wage, 134%. Home prices, 587%. An ounce of gold, 217%. And the winner of the race, the Dow Jones Industrial Average, has gone up 3,810% since 1980 through 2023. Well, what can we learn from all this? Number one, stocks and real estate are great investments over the long term. No doubt about that at all. Number two, the average salary is better than the minimum wage, not only dollar wise, but also percentage wise, meaning it really behooves us to focus on a skill that's very sought after and, to get into a good career, a good profession, because our salary will rise faster as opposed to just making minimum wage. Number three, gold may be a hedge to inflation, but not as good as stocks or real estates. Unfortunately for gold bugs, gold is an inferior investment if you compare it to stocks and real estate. Because remember, we run into inflationary cycles, and inflationary cycles help stocks go up and help real estate goes up, also to go up. True, it's more painful at the gas pump, it's more painful when we go to the supermarket, but if we own stocks or real estate, inflation is on our side. And finally, smart financial decisions. Commit extra capital to long term investments like stocks and real estate and not consumerism, coffee. Well, we all love coffee, but if we can cut out any extra expenses and commit that capital to long term investments, especially if we can buy these long term investments like stocks and real estates on a market dip, that really is, that has proven to be over the long term, a prudent strategy. If you haven't already, please visit our Substack newsletter, substack.com, perfectly free, no registration required. Just enter our details as follows, and you will see our latest publication, The Real Cost of Inflation, as well as the others as well. And again, also, we are also on Twitter, just the data. We hope this has been helpful. We look forward to seeing you back soon.